Hey there, thanks for tuning in. Welcome to Investing in Germany, and today let's have a look at the recent monetary policy decision press release submitted by the European Central Bank on the 15th of December 2022. The link to this document is in the description. In this video, I will focus on the main takeaways from this press release. Therefore, I recommend you to read through the press release. They have packed a lot of information into this press release, so it should be really helpful for you to understand how the monetary policy makers are making those decisions and what is coming in for us for the next. So the European Central Bank has increased the interest rate by 50 basis points or 0.5 percentage. So this brings the overall interest rate to 2.5 percentage. The rate at which we have reached the 2.5 percentage is really crazy here. Back in April 2022, the interest rate was around 0 percentage, and within a year or even less than a year, we have reached to 2.5 percentage, and we have not yet reached the peak. So this is really crazy. And the European Central Bank, they have also revised the inflation outlook higher, which means that we are going to have a high inflation rate for some period of time. So we have to really sit tight and drive through this uncertainty and high inflation rate environment. Interestingly, in this statement, the European Central Bank has given us a guidance on the interest rate hike. They are guiding the market to expect another couple of 50 basis point increase or 0.5 percentage increase 2 times in the next meetings. So from my point of view, this is fair to assume that the interest rate will be at 3.5 percentage by the end of March 2023, because the Governing Council of the ECB or the European Central Bank is going to meet again on the 2nd Feb 2023 and also on the 16th of March 2023. So let's wait and see if the guidance is being maintained by the European Central Bank. This unprecedented increase in the interest rate is highly necessary because the inflation is really high. The inflation rate in November 2022 in the euro area was around 10%. So this is 5 times the target inflation rate, which is 2%. So this is going to be a long journey to reach the 2%. Therefore, the monetary policy makers must really tighten the screws to control this inflation. The inflation now looks like more stubborn, and there are a lot of variables going on in the world, which is really causing the inflation not to come down as the monetary policy makers are expecting. In this statement, the ECB is also worried about the risk of any persistent upward shift in the inflation expectations. I had created a video on this topic, the inflation expectation. The link will be on the screen. I do recommend you watch the other video. It's really informative. In short, the ECB does not want the common man like you and me to expect that we will have a sustained high level of inflation in the euro area, because the price stability is something really important for the monetary policy makers as well as for us, because we don't want to have an ever increasing price in commodities and grocery list and so on. So we just want the price stability, and the price stability is achieved or it's within us at 2%. And also don't forget that the interest rate hike needs at least 12 to 18 months to bring down the inflation. So therefore it is necessary to keep informing the population that the central bank is pushing hard on this to bring down the inflation. Otherwise, the inflation expectation could go high, which will then become really a messy situation for the European Central Bank policymakers. Now, the press release moves from the interest rate to asset purchase program or quantitative easing. Here they are focusing mainly on the quantitative tightening. So quantitative tightening is an opposite of quantitative easing. In short, the quantitative easing is nothing but printing money, and quantitative tightening is withdrawing the money from the market. Quantitative tightening is going to start from March 2023, and for now it will last for 4 months up to the June 2023. And then they will decide the next course of action based on the market feedback and so on. From March 2023 to June 2023, they are going to reduce the balance sheet by an average of 15 billion euros per month, and this will bring us to a sum of 16 billion euros in reduction in 4 months. This balance sheet reduction is very less compared to the trillions printed over the last decade to come out of any crisis. In the past, it was like the central bankers, they were printing out the money to find their way out of the crisis, and now it is like we will have to delete the printed notes to come out of the crisis. Everyone knew that we will end up here at very high inflation rate due to the amount of money that we have been printing in the past decades, but nobody expected that we will reach the situation so early. Thanks to all those unknown variables, just everything came in all together in one period of time. The quantitative tightening is a very delicate process. The European Central Bank has never done a quantitative tightening in the past. The American central bank did a quantitative tightening for a short period before they started to print the money to come out of the pandemic crisis. So for the European central bank, it's very new, as well as for the whole world, it is very new process, and let's see how they are going to manage it. In the press release here, the European Central Bank is making this process more predictable and measurable. This is a polished way of saying that we don't know what to expect and how the market will react. So we are saying that in advance what we are going to do, and please react so that we know how you are reacting, and then we will make a next course of action. This is really funny, but this is how it is going on. I would say that this is a really clever idea by the ECB or the European Central Bank, because why to surprise the market and to get caught in some tide if they have the opportunity to tell what the plan is and how they want to do it and see how the market is reacting. So I think this is a really good move by the European Central Bank policymakers. Why do I say quantitative tightening is really delicate matter is that if it becomes too much and then coupled with the current interest rate hikes, this will really create a lot of issues in the market, and it will even disrupt the market and bring the entire market into a recession, into a deep recession. So this is something that nobody wants to have and nobody really wants to face. So that is why here we have a very slow pace of reducing the balance sheet by the European Central Bank. The complete plan of the quantitative tightening is expected to be finalized by the end of 2023. The European Central Bank's primary tool to control the inflation is the interest rate. It's not going to be the quantitative tightening. So this is really a fair move as well. Therefore, they are taking a lot of time in a slow pace. They are trying to understand the market and to react based on the market reaction. So I think this is a really good way to go ahead without disrupting the market in a big way. The small dip in the inflation from the October 2022 to November 2022 from 10.6% to 10% is due to the low energy price inflation. The European Central Bank is also forecasting that the food price inflation to be in the stress in the near term. So therefore, our grocery bills is not going to come down anytime soon and expect to pay much more higher price in the coming months. So sit tight. The target inflation rate of 2% will not be achieved even in 2025. So we will have a really high inflation in the euro area for the next 3 years. That is for sure. Let's see how long it is going to take. The European Central Bank policymakers, they are projecting a 6.3% interest rate in 2023, which is more than 3 times the target inflation rate. Then 3.4% in 2024, this is a 1.5 times the target inflation rate. And then in 2025, the inflation should reach to 2.3%, which is again above than the target inflation rate. So these are all projections, of course, but then we have to keep in mind that these projections are really best case scenarios. If you consider the worst case scenario, then we might be really bad situation. I will not be even surprised if they again revise the inflation forecast for the upwards in the first quarter of 2023. This is because the war in Russia and Ukraine has no sign of ending. Even though the China is now coming out of the zero COVID policy, we don't know if their healthcare can accommodate infection waves in the coming months. And on top, we have the chip war going on between the West and the Chinese. Thanks to Biden, we have to see how the Chinese is going to retaliate. If the Western countries keep poking them like this, I don't think this inflation is going to come down anytime soon. The final bad news in the press release, trust me, this is the final one, is the recession. They are expecting a shallow and short-lived recession. This is already an expected one. I had also covered this in one of my previous videos. The link to the video will be here on the screen. So go and have a look at it. For me, this is not a surprise. They say it is going to be a shallow and short-lived, but I'm sure that they don't know how shallow and how long the recession is going to be. Of course, no one will create a panic in the market by saying that we will have a terrible year ahead, and then the market really falls and then creates a lot of another issues. Let's wait and see what does this short-lived and shallow means. If you look at the past, the recession has generally been there for 10 to 12 months, and after the recession, the economy really goes in one direction, that is up. So at the worst case, we should expect a 12-month period of recession, but then if a lot of those unknown variables move in the other direction, we might have a really long and deeper recession. So this is unfortunately a waiting game for us to see what is an actual recession and how long and how deep it is going to be. For now, we can assume that this is a shallow, short-lived, maybe maximum 12 months as in the past. In the past, the recession has always been a golden period for the value investors. We as an intelligent investor, we will grab this opportunity which comes once in a decade. So I will be going there and grabbing all those cheaper, fairly priced, even sometimes really underpriced securities from the market. So this is something that is going to be really a great year for me, and I hope it is going to be really a great year for you as well. So sit tight, enjoy the ride, see you in the next video.